While the stock market, rallying today, there are still many headwinds facing investors, from higher rates hitting the consumer to growing geopolitical concerns. And here to discuss how to navigate it all is Ken Stern, president of Lido Advisors, and a new face to Power Lunch. Welcoming him from the West Coast, Lee Munson, president and CIO of Portfolio Wealth Advisors. Gentlemen, welcome. Since Rick just talked about bonds and the fact that you're not compensated for going out longer in the bond area, how do you feel about bonds here? Is now a time to buy in, have some, and if so, of what duration?
You absolutely have to have some. I mean, you're getting paid for liquidity. It's the first time in how many decades that you actually get paid for liquidity. But do you go out much longer? No, I'm not a bull much longer. I actually think that we should stay in the shorter term periods, wait for it to come to us. The market will come in one way or the other. You choose your entry point.
Lee, what kind of portfolio do you run? 60-40, and so you would have some fixed income in there.
I do. So if I take my bond sleeve, that 40% that I have, first of all, I'm about 35%. I'm a little overweight in stocks, but I've got right now 75% of my bonds are in the short term. Just think 6 month to the 2 year. But I started buying in August when we saw the 10-year hit last October's low at a 4.4. So I put in, 5-10% there. A couple weeks ago when we saw the 10-year hit a 4.7, 4.8, I took a little bit more exposure there. When I see the 10-year hit a solid 5, maybe a 5.01, just to, maybe we get one more rate hike just to rattle some nerves, I want to back up that truck. But again, I'm talking about backing up the truck and maybe having 35% of my bond sleeve in long duration. So, I'm aggressive for a conservative player.
Long duration would be 10 years.
10 but years. I also have a little bit of the 30. I like the TLT trade, but I have to tell you, that's a pro trade. You have to know what you're doing. Individual investors can get burned that way, but I only need to see a 10-year go for maybe 5.
So can banks, by the way.
Well, we saw that last March.
Yeah.
So I think that if you have an appetite for risk and you want to make some real money in bonds over the next 1 to 2 years, think about the 10-year at 5%, because if rates go a little bit higher, your losses aren't going to be as much as the gains you can make if we just get back to a 4.2, 4.5.
Ken, it sounds like you're also a little bit cautious about the economy here, that both of you. So on stocks, you seem a little bit wary. You're maybe looking for defensive sectors, but they haven't been such great performers this year. So, maybe that's, in other words, dividend yielders have been under pressure. Utilities, we've talked about under pressure. Healthcare hasn't been trading that great. Consumer staples, forget about it.
All of that is absolutely true. The consumer, though, is tired. And at some point, there's going to be a catch up. At some point, the real wages, if they're not keeping up with inflation, and if we have continued inflation, which I do think the rates are having their intended consequence, I think we're not going to have a very, very exciting holiday season. I think there's going to be some disappointment, and it's time to keep powder dry. And it's also about the velocity. I agree with what you say, Lee, on the 5%. But if we hit 5% quickly, the market's going to be a lot cheaper, and I'm going to be a much bigger bull.
You're very positive long term.
Oh, my gosh, yes.
Why?
Well, think about it. I mean, inflation was caused because of supply issues. We don't have as nearly the supply issues that we did. And in fact, demand's coming in. We're going to see the sun and the moon and the stars get together. The market just needs to be a little bit cheaper. So either it gets cheaper because earnings start to get accelerated, which they're not quite yet, and the market's a little bit expensive. We need it a little cheaper, and then I'm a long-term bull because I love this macro trend. I love trends in finance and healthcare and tech. We're in a macro bull.
It's funny because we're talking about the market multiple, and this is a big point of debate, Lee, as to whether maybe we're around 18 times again. Should that be the new normal? Because the last time rates were this high, I think the multiple was maybe 14 or 15 times early 2000s. So do we need to go back there or not? Because we have AI and GLPs and I don't know, whatever else you want to throw in there.
Those multiples, I think you're going to split the difference. There's a lot more money around than there was the last time that we had rates. So I think that you have to, realize that, for me, I can only buy price. Early October, we priced in what I consider, in my opinion, a soft landing scenario. So I bought that because I don't know. I have my own opinion. I think we're going to have a recession next year. But I said that a year ago. I thought we're going to have a recession this summer, and the job markets proved me wrong. What I'm looking for, like I said, maybe a little rate hike. Earnings are going to be good, but the bank said going forward it's not going to be so great. I'd like to see some other stuff.
Basically, a policy error that you're hoping they get enticed into one more hike just to make sure that recession is around.
Just have some Fed governor just say the wrong thing at the wrong time,
and then you'll get a cheap market.
Exactly. I want to buy a hard landing. Pricing, I think that could happen between now and the end of the year. And again, what is
so you're not in the year-end rally camp. You actually think the year-end could become a period where we hit a much softer patch, pricing in a harder landing event?
I think so, and I think it's going to happen a little quicker. But again, it doesn't matter because the market overprices recessions. What's it priced since World War II? 19 of the last 13 recessions. But again,
when the actual one hits, it usually still has 30% to drop before that bear market bottom.
Yeah.
If that's what you think is really, is really coming.
I think so. I don't think it's going to be actually as bad as people think. But I think that with the Fed, too many investors just do not believe they are going to keep rates higher. And I don't know why they don't listen. When has the Fed lied to us in the last several years? So you got to believe what they say.
Yeah.
And they're going to say it's going to be more pain. And that's we haven't seen the lag yet.
So, Ken, let's tie it off with, obviously the events of last week and the events of the last 18 months, referring to Ukraine, not to mention the tension that is in South China Sea and Taiwan. How do you factor this in? Did you do anything differently last week because of what went on in the Israel-Hamas war?
Yeah, I think, again, when we think about the economics and we think about the finance side, protection of the asset is the first and foremost rule for making money. Don't lose money to make money. And so it's a good time to hedge. It's a good time to be in 6-month treasuries and to be a little bit on the risk-off trade. And then when the markets come to you, we don't time the markets, but entry matters. And you've got to go in at the right point. So, yeah, it is a time to pull it in.
Quick final question, which is like $1 trillion, like a four-part. But, right now you have people like Howard Marks saying that corporate credit is the place to be, that high-yield corporate credit looks better, that the 60-40 portfolio is dead, and you should at least be diversifying into commodities or real. I mean, you guys have heard some of this. So, Ken, just real quickly, does stock and bond, is that enough these days, or should people be throwing out the playbook and doing something totally different?
I'm not a fan of just having a certain percentage in a stock or a bond, and I do love private credit right now. Banks are tight, and private credit is finally giving us the yield and getting us paid for that risk that you're taking. It's a good time for private credit.
All right, gentlemen. And Lee, have a great ski season at Taos. It's
Coming
coming soon.
I can't wait. I can
Coming
feel it.
soon.
We're coming to you next time. How's that? Gentlemen, thanks.
Great to have you both in the house. We appreciate it.
Thank you so much.
Thank you.